This is a High Mount Research portfolio applications video for April 6, 2023. Hello, everybody. Willie Delwich here. Thank you for joining me on this Thursday morning, Thursday noon or so, about the time when I'm recording this. Final trading day of this week as the markets are closed tomorrow for the Good Friday holiday. We're actually we've had small moves in the S&P 500 most of this week. We're actually now looking at potentially the second week, going back to early 2022, maybe late 2021. Only the second week without a 1% swing in the S&P 500 during that week. Granted, it's a 4-day week this week rather than a 5-day week, but still, less day-to-day volatility is a sign of healing in the market. If that can persist, that would be a good sign going forward. So that's where we are this week. Let's get into our conversation, walk through what we have to talk about this week. Today's conversation: evidence argues for more caution, just to reflect on the changes that we made to the weight of the evidence. So far, the rally we've seen since the Q4 lows behaving more like a bounce, not so much like a bull market. Reference the bull market behavior checklist that we included in our weekly market notes earlier this week. Go through a couple of the charts related to that. Won't go through the whole list there, but really behaving more like a bounce. Investors, from a positioning perspective, and this is one of the reasons why we downgraded sentiment in the weight of the evidence from bullish to neutral, is that investors remain heavily exposed to equities. The question is, are they poised to abandon them, reduce exposure there? If so, that's a headwind for stocks. One of the things that could be a catalyst for that, we've got earnings revisions rolling over. Also have bond yields offering competition, but earnings revisions had been strong, starting to see that not be the case anymore. From a short-term sentiment perspective, bulls are back. We're seeing it in the II data, the NAIM data, even individual investors, still more bears than bulls, but the AAII bull bear ratio above where it was in August. We'll take a look at that. The market is expecting a Fed pivot. The question is that good for stocks? We'll look at what the recent history has said about that. And then we'll get into the portfolio applications, look at our asset allocation models and what we have done about that in our dynamic portfolio. So that's the roadmap. Thank you for joining. Let's get right into it. When we weigh the evidence, it shifted this month. It was neutral coming into March. We had all the market related metrics on the opportunity side. Trends and momentum in March were joined by breadth and sentiment. Breadth has deteriorated, sentiment has deteriorated. So those are down to neutral. From a risk perspective, financial liquidity has improved. We'll get into why I say that, even as central banks remain in tightening mode and have so far tried to hammer home the message to equities and to the bond market that they expect to continue to go higher. We're seeing some evidence of improved liquidity. So take that off of the risk side, put it in neutral, at least for now. We'll see how long we can stay there. Sum it all up, we've got 2 on the risk side, 1 on the opportunity side. That's an argument for a bit more caution than we saw in Q1 of this year. In terms of how the market is behaving, what we saw in Q1 versus what we're seeing now: started Q1 33 days in a row of more new highs than new lows, choppy for a little bit, and then finished the quarter with 19 days in a row of more new lows than new highs. If you've listened to me for any amount of time, you know that I like to pay attention to not the number of new highs or the number of new lows, but where they are relative to each other. Are there more new highs than new lows? If so, that's bull market behavior. Are there more new lows than new highs? If so, that's not bull market behavior. So one day of more new highs and new lows, just by a smidge earlier this week, but since then it's been back to more new lows. As long as that persists, that's a headwind for the indexes. We'll get into that going forward. Within the individual indexes, looking at trend strength by market cap, we saw a tremendous improvement in terms of the percentage of stocks with 50-day averages above their 200-day averages, as Q3 of last year, and then especially Q4 and into the first part of this year. At its peak in March, we had 72%, nearly 3/4 of the stocks in the mid cap 400 had 50-day averages above their 200-day averages. That's the best level since the summer of 2021. Since then, that's dropped down to 64% for the S&P 500. We've dropped from 66% down to 59%. More modest deterioration among small caps, but still we're seeing rolling over beneath the surface from a trend perspective. That's not too uncommon given some of the volatility we've seen. The question as we go forward is, was this just kind of a short-lived recovery, or will this be the consolidation? We don't know that yet. It would be healthy to see these numbers start to turn higher again. That is the takeaway. It was healthy to see them expand. Not terribly unhealthy at this point to see them consolidate, but we don't want further deterioration to emerge beneath the surface. That would be a troubling headwind. The type of thing that would argue for taking breath, not just from bullish to neutral, but actually downgrading it further to bearish. Through the course of the first quarter, we saw this, what had been a high level of volatility and a lot of strength. So 2023 began up here in this upper right-hand area where we had a fair number of 1% swings on the S&P 500 to go with a whole lot of more new highs and new lows. So like I said, started the year with 33 days of more new highs and new lows. As the quarter wore on, this moved over to the left. So we still got the volatility, but we saw less strength. It's not at a troubling level at this point, but the direction is towards where we were last year, towards where we were in 08 and 74. So it's not moving in the favor of strength. It's moving towards kind of the headwind type markets that we've seen in the past. Also from a sector level perspective, we've not seen the sort of strength in terms of sector participation that typifies bull market behavior. Typically in bull markets, you get 9 or more sectors above their 200-day averages, and then they stay there. You have that on a consistent basis. Saw that coming off of the COVID lows and into the into the 2022 peak for the S&P 500. Saw that in 2019. Saw that in 2017. Saw that coming off of the 2016 lows, where you have broad participation. We haven't seen that right now. And just as a reminder, the S&P 500 does the best when you have 9 or more sectors above their 200-day averages, or when it's so washed out that you have only 0 or 1 sectors above their 200-day averages. This is similar to that fear or strength model that we have, where we look at breadth in terms of net new highs, and then also overlay that with the VIX. Stocks do well when there's strength, do well when there's fear. They don't do so well when neither of those is present. That's the message of this, just from a sector perspective. When you're muddling in the middle, the S&P doesn't tend to do so well. And that's where we've been really for most of last year. It had a brief period of fear, brief period of strength, but since then it's been back into the middle. 7 sectors right now above their 200-day averages. From an industry group perspective, industry group trends improved tremendously off of those late 2022 lows. That's similar to what we saw again off the COVID lows, coming out of late 2018, early 2019, and coming out of early 2016. You have this dramatic expansion in industry group trends. Typically it consolidates somewhere around where it is right now. It carried a little higher this time, and now the correction has been a little bit lower. A sign of bull market behavior would be industry group trends starting to expand again. They haven't at this point. Still consolidating, still working lower. And then ultimately, we get to what's probably my primary breadth indicator, this net new high advanced decline line. Here we're looking at it compared to the S&P 500 and the trend in the S&P 500, the blue line there. That's a long-term regression-based trend that I like to use. And the takeaway here is when the net new high advanced decline line is moving lower, the tape is not, the trend is not your friend if you're bullish. Don't look for the ups, things to move higher, for strength to persist, to rallies to be sustained. If you're doing that in this environment, you are fighting the tape. Um, as long as we see more stocks making new lows than new highs, um, the trend here is lower, and that's hard for stocks to sustain strength in that environment. So really, it's a less is more type environment. If we see new highs expand, this turns higher, well, then the tape is more friendly to the bullish argument. Not the case right now. How are investors positioned through all this? This is the AI asset allocation survey for March. So it's data through the end of March, came out earlier this week, saw it Monday morning. And stock exposure remains historically high, above average. Bond exposure and cash exposure remains below average. And in fact, equity exposure has been high, even, all through last year's bear market, and into this year. Investors have not abandoned equities, which is interesting given how they feel about equities. So here we're looking at a dot plot that on the horizontal axis, this is consumer sentiment from the University of Michigan. On the vertical axis, that's the equity exposure that we're just looking at from the AAI survey. And the trend line is pretty strong. Typically, when investors feel good, they've got a lot of equity exposure. When they don't feel good, they don't have much equity exposure. 2022 was an outlier, was an aberration, and that's persisted so far this year. We've had this reduction in optimism. The consumer sentiment has gone south. Equity exposure has remained elevated. My contention, my concern is that the longer sentiment remains depressed, the more likely it is that investors are going to abandon equities and start to reduce equity exposure. That the reduction of equity exposure is a headwind for equities. Getting to reduced equity exposure sets up better returns. The getting there is a headwind, though. And what could kind of lead to some of that transition, we talked about it a couple of weeks ago from a long-term secular perspective. And just as a reminder, the catalyst in this environment, I think, is bond yields. Bond yields are offering some competition for stocks that hasn't been around for the past 2 decades. So investors have kept elevated equity exposure because there haven't been other places to go. That's not the case in this environment. Just within equities, investors are seeing strength finally from overseas. In fact, relative leadership overseas, we'll get to that. So that there's a catalyst for switching out of U.S. equities. But from equities overall, we finally have bond yields that offer some relative attractiveness versus what stocks are yielding. So green line here, that's that's the forward earnings yield for the S&P 500, which is a fancy way of saying the forward PE ratio, divided by 1, so turned upside down, earnings over price. And this is expected earnings, 5.3% for an earnings yield, 4.6% for a 1-year T-note yield. So that's competition, competition the likes of which stocks have not seen in over 20 years. So from an asset allocation perspective, long-term perspective, holding stocks has become relatively more expensive because bonds offer a better alternative. Shorter-term catalyst to abandon stocks might be this earnings revision trend that we've talked about. Talked about it holding steady as being a sign of strength, even though we're talking about macro headwinds and things like that. As long as earnings were being revised higher, it was hard to really sink our teeth into some of those macro concerns. Well, that's not the case now. This earnings revision trend peaked in March and now has started to roll over. This is for the S&P 400. We've seen the same thing from an S&P 1500 perspective. Earnings revisions are being revised lower, so that trend is rolling over. That makes some of the macro tensions a bit more acute from an equity market perspective. So that's kind of the big picture positioning argument. Then shorter term, we can think about things just from a sentiment survey perspective. This is the investors intelligence data, the weekly bulls and bears. So you can see green line, that's the bulls, surged up to almost 50% this week. ties the highest level that we've seen since the first week of 2022. So we've got some, investors moving back towards embracing equities. Bears on that survey, not historically low, no more than bulls are historically high, but certainly low relative to where they've been over the past year and a half or so. And the spread now above 20, above where it was in August. We've marked that as an important level because if you go back to 2015, all of the net gains in the S&P 500, almost all of them, have come after this bull bear spread has crossed above 18. So when we saw that earlier this year, that was an encouraging sign that bulls were ready to embrace this rally, and you need bulls to have a bull market. What we saw since then was discouraging. You saw some apathy develop. You saw it in the investors in the AI data, where you had 2 weeks in a row of more bulls and bears, and then was back to more bears, which it's still there. But we want to see, if we're looking higher, if we want to look from a bullish perspective, we want to see optimism emerge, as long as it stays short of excessive, and we're nowhere near excessive optimism at this point. Look at it across the indicators. So here in the middle, that's the bull bear spread we were just looking at from Investors Intelligence above the August level. The green here, that's AAII, individual investors, still below zero. So still more bears than bulls, but above where it was in August. So that's encouraging. And then the blue line, that's the NAIM exposure index, active investment managers, just above where we were in August. We're at 72% in August, at 73% as of this morning. So we're seeing that, it was a little bit herky jerky over the past few weeks, but looks like investors are moving back towards embracing equities. That is important. That I think, given where we are from a positioning perspective, and given some of the higher level macro concerns, if investors abandon equities from a sentiment perspective, that puts downward pressure on price. Embracing them at this point helps keep sentiment from moving from bullish to neutral, then neutral to bearish. It helps keep it at that neutral level. We don't need to, in this environment, overcomplicate things and think about sentiment from a contrarian perspective and think, well, optimism is bad, pessimism is good. Don't think about it like that. Right now, having moved away from peak pessimism and moving with the crowd at this point, we want to think about optimism as being bullish for stocks, pessimism as being bearish for stocks, and up until the point we get to extreme optimism. But like I said, we are nowhere near that level at this point. And so we want to see investors embrace equities. The data we saw this week as an encouraging step in that regard. Looking at corporate bond yields, this sets up the improvement in liquidity that we've seen. So first, just the blue line here, that's the level of corporate bond yields, spiked last year and has settled into a range between where it was in 2010 and then the 2018 high. Hasn't broken down, has stopped going up though, and momentum has cooled because we're now 6 months past where it was spiking. So it's lower than it was 6 months ago. That's 26 weeks. Why are we looking at that? We're looking at that because anytime that 26-week momentum has turned negative, that's when all the gains for the S&P 500 have come, not just back to 2000, which is what we're showing here, but really back into the 60s. It is an incredibly bullish tailwind for equities, for corporate bond yields to be lower than they were 6 months ago. That is what we're seeing right now. That's what has emerged over the past couple of weeks as investors have started to look for lower yields, have started to push corporate bond yields lower. And this just looks at the divergence between where the Fed is looking, which is higher. As of the March SEP, looking at 5% or higher for year-end Fed funds rate, probability weighted average 5.15% for the year-end Fed funds rate. What's the market thinking? The market's thinking, no way, you're going to be cutting rates. And in fact, not just cutting them once or twice, but a full percentage point lower than where you think you're going to end up with. So three cuts over the second half of this year is what the market is pricing in at this point. Big divergence between where the Fed is looking and where the market is looking. And so then that raises the question of, okay, well, maybe the market's right. Maybe the Fed is done raising rates and is poised to cut rates. What do stocks do in that environment? Well, looking at the past 5 instances, there kind of two different stories emerge. Most of the time, the period between the final rate hike and the first rate cut, stocks have done pretty well. In the case in 2018 into 2019, was the case in 2006 heading into 2007, was the case in 95, was the case in the late 80s. The exception was coming after that, the internet bubble peak for stocks. So 2000 into 2001, equities S&P 500 was down 8%. And so the question is, kind of, let's not just take probabilities and say, well, 4 out of 5 chance you'll be right. What is the current environment similar to these past instances, or is it more similar to the outlier? Given that it's two distinct paths, and I would argue, given the secular headwinds that we're talking about, given the possibility of a secular bear market, starting this, I don't think we want to totally dismiss what we saw in 2000, 2001 as being a possibility, that this idea that, while the Fed pauses, it's going to be a good thing for equities. If it's pausing in the early stages of a secular bear market, it's probably not such a good thing. And then if we go back further into history, so these are just the past 5 examples, go back prior to that, and almost every instance between, after the final rate hike, stocks were down 6 months later. So not necessarily something to be applauded if we do actually get that pivot from the Fed that the market is looking for. But before we even get that, we need the Fed to start to talk about to stop talking about higher rates, not just that would be the move before starting to think about lower rates and rate cuts. And so what does this all mean from a portfolio positioning perspective? Where are we seeing strength from within our allocation models? Where are we seeing leadership? From a global equity perspective, the U.S. has faltered. It's below neutral in terms of positioning. Leadership really is with the UK and Europe ex UK. That's where it's been for a while now. Canada gets no love. Japan and Pacific ex Japan are starting to move lower a little bit as well. Most of the move lower for these three is more about the shift higher from the UK and Europe ex UK versus any sort of weakness on their part. U.S. equity exposure from a 6-way size and style perspective, large cap value moving towards max overweight. Mid cap growth is improving. Mid cap value is sliding a little bit still from an overweight perspective. The underweights, large cap growth, short term strength, yes. Long term leadership, no. Small caps starting to struggle a little bit. So overall, we're seeing this shift from small caps towards large caps, especially large cap value. From a sector perspective, tech is gaining strength. Industrials remain strong. Energy remains strong. This hasn't been the case necessarily this week. Industrials have come under some pressure this week in terms of where the market is reduced, or where the model is reducing exposure. Staples, financials remain, remain an underweight. Communication services and utilities. Financials is interesting because we didn't just see brief weakness there, followed by rebound. We saw weakness in financials. The rest of the markets rebounded some, but financials have not really gotten any traction. So that's kind of the market has moved on overall, equities anyway, from that concern. Bonds haven't necessarily, and financials, within the financials sector itself, haven't moved on from some of those early March, banking issues that emerged there. When we aggregate this up, kind of look at from a global perspective, the size and style perspective, overlay that with a stock and bond and commodities model. What do we end up with in terms of weightings, particularly where's the model overweighting, where's the model underweighting, large cap value, Europe ex UK from an equity perspective, and then bonds remain an overweight from an asset class perspective. What's interesting is that even though the U.S. is in an underweight position, the strength in large cap value actually, pushes exposure within this model, pushes exposure to large cap value above its long-term average. Small cap, large cap growth below average. Mid caps are in line with their averages. Small caps within the U.S. below average. So the advantage of combining the models, layering them on top is we start to can see some context there, and it's not just underweight everything within the U.S. It's underweight the weak parts in the U.S., but that might actually mean overweighting the strong parts in the U.S., even from a global equity perspective. And just some long-term context, because I think that's really important as we think about secular trends. Keep in mind that we've just come through this period of persistent U.S. leadership. We had these uptrends in the U.S. versus the rest of the world were extended, persisted over time. Down, periods of global leadership, of ex-U.S. leadership, short-lived, didn't really go anywhere. We're now at 17 weeks in a row of ACWI ex-U.S. leading the U.S. It could be that we're just, back into this environment here where it's a little bit of rest of the world leadership, and then the U.S. gets back in gear. I think it's more likely that we're in this environment where we have persistent global leadership. So persistent leadership away from the U.S., away from U.S. large cap growth. That changes the world, changes the allocation mindset, or at least should, for a lot of investors who are conditioned to see U.S. leadership. If stocks are rallying, it's the U.S. leading the way. If the U.S. is leading the way, it's large cap growth leading the way. That's been the case for the past decade. That's not the historical norm in all cases. This is just an example that we might need to think fresh about, global leadership and kind of unlearning some of the patterns of the past decade. In terms of positioning within our portfolios, this is a dynamic strategic portfolio. Didn't change any of the domestic versus foreign exposure here. We tweaked where we have domestic exposure, moved some of it out of mid cap into large cap value, moved some of it out of Pacific ex Japan into the Eurozone. Still, this is a case of more global equity exposure than domestic equity exposure, and relative balance between equity exposure and fixed income exposure, which actually then if it's 50-50 there, and it's not quite, it's close, but if it is a relative underweight to equities, a relative overweight to fixed income. So that's our dynamic portfolio. Think about changing that every quarter or so, tweaking it, making sure we stay in harmony with the leadership. Our cyclical portfolio, here's the one we look at from a monthly perspective. Made some larger changes here to make sure that we were in line with that theme of foreign equity leadership. So got out of mid caps, got out of small caps, moved into Europe, moved into Mexico. Mexico's been a relative leader, even though it's neither developed market nor European. It's still relatively strong, and also raised a little bit of cash in this portfolio, consistent with that weighted the evidence, arguing for a little bit more caution. Shorter term tactical portfolio, we want to keep an eye on what we're seeing from a breadth perspective in terms, our fear strength model, our sector trend model. Not so much the long term positioning from some of those other models. Want to have that in mind to help let us know where to look, but that's not the be all and end all. Still a lot of cash here. Moved out of European financials. and distributed that exposure across industrial semiconductors, Mexico. Um, and this is just to look at our ETF universe rankings, kind of a little shorter term, but it explains why we're moving into gold, into semiconductors, from a tactical perspective, because that's the short term leadership. There's semiconductors. You have gold. You have Europe. Europe is in here as well. So those are the areas right now that are seeing the new highs, are seeing the strength, are seeing the leadership. From a tactical perspective, that's where we're looking. How long that lasts remains to be seen. And then just two final charts before we wrap it up. Shorter term perspective, still range bound. Peaked briefly above 4,100. Maybe we'll get there again on the S&P 500. Maybe we won't. But as long as we see more new lows and new highs, I think certainly the sideways action is intact. Probably there's a bias lower from a trend perspective, but kind of zoom out, and the S&P 500 is not just a range this year. It's really a range going back to the middle part last year. Really, you could make the case that it goes back a year. Look at the number of times we've traded around 4,100 over the past year. This is a new environment for investors to think about sideways action, that it's not always up or always down. These range bound markets persist at times. From a short-term perspective, we also see them from a long-term perspective. Here's that secular argument that I think from a US perspective, we need to at least consider that given where we are from an equity exposure perspective, we could be at the beginning stages of sideways action. Doesn't mean straight down, doesn't mean we're going to zero, but it does mean be prepared for an environment that is not like the past decade. Past decade, it didn't matter when you bought, it didn't matter so much what you bought. The underlying trend was higher, so that was a tailwind. If we're in a secular environment, of a secular bear market environment where we trade sideways, then what you're getting and when you're getting it matter a lot more than those secular bull markets where strength persists and it's up and to the right over time. This is not an up and to the right type environment. So that's the big picture perspective. There is the short-term trading range could actually go on not just for 6 months, could be 6 years. Look for leadership within that, look for opportunities within that. I think a great way to do that is expanding the opportunity set, keeping commodities as part of the conversation, not getting stuck in a home country bias that says US exposure is a way to go. Think overseas. Think about European exposure, think about EM exposure, think about bonds. Bonds are an attractive option now relative to where they've been over the past 2 decades. So those are the portfolio application thoughts for this week. Thanks for listening. We'll have another one of these at the beginning of next month. In the meanwhile, we'll have shorter market insights updates as we go from a week to week perspective to try to kind of tune out the noise, focus on what's important, curate and distill the information into meaningful insights and ultimately portfolio applications. Thanks for listening, and I'll talk to you again soon.